know the debt has to be rolled. We know the forward-looking liquidity is coming, and we know how assets react to it. So it's like having a crystal ball. Nothing will be perfect, but directionally, it should be right.
Raoul Pal explores the wild banana zone. And what's next for crypto? Let's dive in and see where it's all headed.
So when you look at it, global M2 is a good proxy for total global liquidity. Why I use this on these charts is it's more real time. Total global liquidity is takes a longer to calculate for the various data inputs. But global M2 does a very good job. Again, like the dollar version, this is wildly outperforming what happened at the Trump previous cycle. So we've got plenty of dollar liquidity. Global M2 is driven by two things: the dollar itself, which is why it's accelerating so much, and then the global financial system, that's the banks. And what they're doing now, all of the governments around the world and the central banks are forcing the banks to buy debts. Basel IV is the reason behind that. The new changes to the SLR in the US. All of this is a way of forcing bonds and debt into the banking system, and then forcing the banks to create more money using them as reserves. It's just another way of debasing the currency. So global M2, when we look at it outright, it does the same pattern every time. These patterns repeat not out of voodoo, it's because it's driven by the debt refi cycle. The average maturity of global debt is 4 years. They're all between the 3 and 5 year sector. There's some long-term debt. Nobody can issue long-term debt because the market won't absorb it. So what we find is we're shorter term. Every time we do this, we have a breakout, a retest. So this was the 16-17 cycle. This is the equivalent one, I think, now. Breakout, retest, explodes higher, does this whole liquidity tightening. That's the bear market. That's when the economy slows down. That's when rates go up. Does the same thing. COVID gave it a false, a double shot. It did it again. We're doing exactly the same thing. It's almost a complete repeat of the 2017. So what we're seeing is global M2 at all-time highs. That should mean all-time highs for asset prices. That's how the world works. What we've also got here is global M2 against Bitcoin. So it's the same chart, but now we can see what happens to Bitcoin every time this happens. It breaks out, retest, and then Bitcoin starts hitting the next leg of the banana zone. Usually you start the banana zone a bit earlier with the breakout, you have the correction, and then it goes. And I've talked about this. There's 3 phases of the banana zone. Phase 1 was Q1 last year, as we started to break out in all these measures, new all-time highs in liquidity. Bitcoin goes to all-time highs. We have the corrective period, which is the correction zone, and then we get the banana zone part 2, which is usually alt season.
Bitcoin enters the first full week of May at a pivotal moment, trading just above $93,500 and facing mounting pressure from both technical and macroeconomic fronts. With the Federal Reserve's interest rate decision looming, traders are watching closely to see whether Bitcoin can maintain support at its yearly open or slip further amid growing market uncertainty. The May 7 Fed meeting is expected to influence all risk assets, and while no major policy shift is predicted, Fed Chair Jerome Powell's tone could spark significant price moves. Despite recent selling pressure and profit-taking, sentiment among traders remains cautiously optimistic. Bitcoin dominance has surged to 65%, its highest level in over 4 years. But analysts like Rect Capital warn that a collapse could be coming if dominance nears the 71% mark. That level has historically marked a peak before altcoins begin outperforming. However, others argue this cycle is different due to institutional demand, with firms like BlackRock and Strategy holding large amounts of Bitcoin without rotating into altcoins. At the same time, recession fears in the U.S. are growing. Consumer confidence is declining, and recent job data adds to concerns about an economic slowdown. With BTC price hovering near key levels and altcoin investors waiting for their turn, Bitcoin's next move will likely define market sentiment for weeks to come. Whether it breaks higher or pulls back, all eyes are now on the charts and the Fed.
This is the fabled chart that everybody in the world has copied from me, but this is the global M2 chart versus Bitcoin with a 12-week lead. It's been like voodoo. It is the most voodoo-like chart I've ever come across, and it works. Will it work entirely? Often what you find is later on, Bitcoin outperforms global M2 because of the speculative mania that builds over time as people realize what's going on. What it tells us is the back end of this year is basically a one-way street with a few corrections. The corrections will be normal. You will be questioning me saying, Is it all finished? Is the banana zone finished? Is it all over? Do I need to get out now? And generally speaking, just follow the money. It really is that simple. The other thing is, okay, well, with the dollar and the banking systems doing this, well, the other thing that's doing it is the central banks. China is starting to print money. China has, I think, by my measure, 3 to 4 trillion to print, but they need the weaker dollar. They need to agree the tariffs with the US. In exchange, the US will continue to weaken the dollar. They will allow the dollars into the Chinese system so they can refi all of the dollar debts. And a lot of China debts, all of the corporate debts are in dollars. So what happens is we're starting to break out, and that adds to this push of liquidity. So it's not just the weaker dollar itself, it's not just the banking system, but it's the central banks starting to pump liquidity into the system as well, because they've all got to roll the debt. And that's why it is so cyclical. Every time the total global liquidity index breaks out, again, the same thing with M2, the market goes higher. And the reason being is I talked about the correlation. Well, here's the chart. It's a 90% correlation with weekly global liquidity. That's Bitcoin. And the NASDAQ is a stunning 95%. And so it's hard to refute that this is not what is happening. It's so obvious, but most people want to refuse to believe it. They start mid-curving the whole thing, saying, well, that's not the printing of money, and this is not how it is. It's so clear in the data. It's so obvious that this has been going on. And even when you listen to Scott Bessent speak or Janet Yellen speak, they all talk about this. They talk it about in the terms of basically the everything code framework.
Arthur Hayes, co-founder of BitMEX, doesn't see the United States increasing its Bitcoin holdings anytime soon. In a recent interview on May 1, Hayes expressed skepticism about the idea of a formal U.S. Bitcoin reserve, arguing that no elected official would risk public backlash by openly supporting money printing to buy Bitcoin, especially given the lingering perception of Bitcoin bras going to the club. Despite President Trump's executive order in March to create a strategic Bitcoin and digital asset reserve, Hayes believes the ballooning national deficit and political optics make such a move unlikely. Currently, the U.S. government holds about 200,000 BTC, valued at over $18 billion. Most of that stash comes from assets seized in criminal investigations, such as the Silk Road and Bitfinex cases. While Hayes is doubtful about future expansion, others in the crypto space believe U.S. accumulation could spark a global Bitcoin race. Surjit Khan's of 1inch suggested it might trigger a domino effect, prompting other countries to start building reserves. Hayes also shared his market outlook, predicting Bitcoin dominance could return to 70%, a level not seen since before the 2021 altcoin boom. He still believes in the traditional cycle of capital rotating from Bitcoin to altcoins, though analysts like Benjamin Cowan and Kai Nunju question whether that pattern still holds true in today's evolving market. That's all for today's video. Until next time.